By the end of this video, you will fully understand 7 most used investing and trading strategies used in crypto. And like every video on Bitcoin Academy, this one is also 100% beginner friendly. So even if you don't know anything, you will be able to follow through. World of cryptocurrencies is evolving faster than ever before, and this knowledge can change your life. So let's stop wasting time and dive straight into first strategy for today. Strategy number 1, dollar cost average. All right, imagine you love pizza. Let's say the price of pizza fluctuates. Some days it's $10, other days it's $15, and sometimes it's on sale for $5. Instead of spending all your money on pizza when it's expensive, you decide to buy one slice every Friday no matter the price. Over time, this means you'll sometimes buy when it's cheap and sometimes when it's expensive. But in the long run, you average out the cost and don't overpay. That's exactly how dollar cost averaging works in crypto. Instead of dumping all your money into Bitcoin at once, you invest a fixed amount at regular intervals, whether the price is up or down. This way, you avoid the stress of timing the market. Let's say you decide to invest $50 in Bitcoin every week for 1 year. January, Bitcoin is at $40,000. You buy 0.00125 BTC. March, Bitcoin drops to $20,000. You buy 0.0025 BTC. June, Bitcoin goes up to $30,000. You buy 0.00167 BTC. December, Bitcoin is at $50,000. You buy 0.001 BTC. By the end of the year, you've accumulated more BTC than if you had put all your money in at the start when the price was high. You took advantage of lower prices while reducing risk. Why is DCA perfect for crypto? Crypto is crazy volatile. One day Bitcoin is up 10%, the next day it's down 15%. Instead of stressing about price swings, DCA lets you stay consistent without emotional decisions. Avoid FOMO, buying at the top and panic selling at the bottom. Build wealth long-term without needing expert trading skills. Even the biggest investors, like MicroStrategy, use a form of DCA to accumulate Bitcoin over time. And getting started is super simple. Here's what you do. 1, pick an amount you're comfortable with. Could be $10 per week or $100 per month. Just make sure it's money you won't need tomorrow. 2, choose a crypto exchange. If you don't know anything about exchanges, no worries. There is a tutorial for complete beginners on our channel, which will help you set everything up. 3, decide on the crypto. Most people DCA into top 5 cryptocurrencies, and for a good reason. You see, DCA strategy is long-term, which means you want to invest into stable assets that you believe will be successful long-term. So the bigger that currency is, the less volatile it is, making it less risky to invest in. 4, set it and forget it. No need to check prices every day. Let time do the work. But what if crypto crashes? A lot of people ask, what if Bitcoin drops 50%? Well, here's the magic of DCA. If you invested $100 at $60,000 BTC, you'd only have 0.00167 BTC. But if you kept DCAing and Bitcoin dropped to $30,000, your same $100 would now get you 0.0033 BTC, double what you got before. So instead of fearing a crash, you accumulate more Bitcoin at lower prices. History shows that long-term, Bitcoin always recovers. And if you want to understand why Bitcoin is gaining value while traditional currencies are losing value every day, make sure to check our video, which explains everything about Bitcoin you need to know. Okay, let's do a short recap of dollar cost average investing strategy. You invest a fixed amount of traditional currency every fixed amount of time you choose. This way, if the price is going up, your previously bought asset gained value. And if the price is going down, you can get more assets for the same amount of money. It is a long-term investing strategy and will only make sense if you believe that asset will perform better than traditional currency you are investing in. I like to call it a smarter way of saving money. Okay, moving on to strategy number 2, which is buy and hold strategy. What is buy and hold? All right, let's break it down. Buy and hold is exactly what it sounds like. You buy crypto you believe in. You hold it for years, no matter what the price does. You ignore short-term crashes and hype cycles. Sounds too simple, right? But this strategy has made Bitcoin investors millionaires without needing to trade every day. Let's make some real-life comparison. Imagine you bought a piece of land in a growing city. You don't sell it just because the price drops for a year. You hold it for 10+ years until more infrastructure gets built around it and it becomes super valuable. Crypto works the same way. The longer you hold, the more likely your investment grows massively. As we already said, crypto is extremely volatile. But if you zoom out, Bitcoin, Ethereum, and other strong projects have always increased in value over time. Bitcoin's history: 2013, $100; 2017, 20,000; 2021, 69,000; 2022, 15,000; and 24, 100,000 plus. If you had held your Bitcoin for 5+ years, you'd still be in massive profit, even after multiple crashes. Key idea: most people panic sell during dips, but smart investors hold and wait for the next bull run. Now, you might be thinking, but what if I trade instead? Here's a crazy fact. Studies show that 90% of traders lose money because they try to time the market. Meanwhile, most long-term holders who invest in strong projects make huge gains over time. Example: if you bought one Bitcoin at $10,000 in 2020 and just held it, you would have seen it rise to $69,000 in 2021, a 590% gain. Meanwhile, a trader might have bought and sold multiple times and ended up with less profit or even losses. The problem with trading: you need to time the market perfectly. You might sell too early. Emotions like fear and greed make you take bad trades. The easiest way to win is to buy good crypto and hold it for years. So, what should you actually buy and hold? Strong, established cryptos with long-term potential. Avoid meme coins and hype projects. Many new cryptos pump and dump fast. Stick to proven assets with this strategy. Now, a big question: when should you sell? 3 smart strategies. 1. Sell a portion in bull runs. Take some profits when Bitcoin is at record highs. 2. Hold a percent forever. Some people never sell all their Bitcoin, treating it like digital gold. 3. Reinvest in strong projects. Shift profits into other growing assets. Example: if you bought Bitcoin at $10,000, you could sell 50% at $50,000 and still keep the rest for future gains. Buy and hold doesn't mean never selling. It means holding long enough to see massive returns. But before you start holding, watch out for these common mistakes. Selling during crashes. Every bull market has dips. Smart investors hold through them. Holding bad coins. Don't hold hype projects with no real value. Not taking profits. It's okay to take some profits in bull runs. Okay, let's finish this strategy by saying that you should use it if you want to build long-term wealth without stress. Don't want to worry about short-term price moves. Believe in the future of asset you are investing in. You have a great chunk of money you can invest, which won't affect you for the next 2 to 3 years. Let me know in the comments. Are you a holder or do you prefer trading? And if you found this helpful, smash that like button. Okay, moving on to strategy number 3, which is trend following. Trend following means one thing: if the price is going up, you buy. If the price is going down, you stay out or sell. Sounds too easy, right? But this is exactly how some of the most successful traders make money. Think of it like skateboarding. If the road is smooth and downhill, you keep going. But if you hit an uphill or rough patch, you stop or change direction. Trend following does the same thing. You ride the wave until it slows down. Crypto is crazy volatile, but guess what? It also forms clear trends over time. Here's an example. Bitcoin 2020-2021 went from $10,000 to $60,000, which was a strong uptrend. Bitcoin 2022 crashed from $60,000 to $20,000, which was a downtrend. If you follow trends, you avoid getting caught buying at the top and holding through a crash. Trend following is all about riding momentum and not fighting the market. Okay, so how do we know if Bitcoin or Ethereum is in a trend? Here are 2 easy methods. Method number 1, moving averages, or MAs, which is nothing more than the line that calculates the average price over a set number of periods. So if you see MA 25, it means it's a 25-day period. MA 50 is a 50-day, and so on. Okay, now I will show you where and how to actually see those lines. First, go to your browser and type Binance Bitcoin USDT. Click on Binance Spot. Now you can see a chart. In the top left of the chart, you can see a drop-down menu with 3 moving averages that were set as default. Now you can go to Options and choose each MA period and line color. So let's do that. Let's use 50-day and make it blue, and 200-day and make it red. And as you can see, now these 2 lines are visible on this chart. Okay, now that you understand this, let's get back to the strategy. How it works: if Bitcoin's price is above the 50-day moving average, it's in an uptrend signaling you to buy. If it's below, it's in a downtrend. Stay out or sell. Example: Bitcoin in 2021 stayed above the 50-day MA for months. That was a sign of a strong trend. Method number 2, the golden cross and death cross. Sounds scary, but it's actually simple. Golden cross equals uptrend signal. When the 50-day moving average crosses above the 200-day moving average, it's a sign to buy. Death cross equals downtrend warning. When the 50-day MA crosses below the 200-day MA, it's a sign to stay out or sell. Example, in 2019, Bitcoin had a golden cross at $5,000 and went to $60,000. In 2022, Bitcoin had a death cross at $48,000 and dropped to $20,000. If you had followed these signals, you could have made nice profits. Simple trend following plan. 1. Identify the trend. Use moving averages or golden crosses. 2. Enter the trade. If the trend is up, buy when price is closer to the moving average line. If it's below, stay out or sell. 3. Ride the trend until it weakens. Don't exit too early, but also don't stay too long. Example trade, Ethereum breakout 2021. Price breaks above $3,000. Uptrend is confirmed, you enter trade. Ethereum hits $4,500 but starts breaking down, you exit trade. Plus 50% without guessing. Now before you go all in on trend following, watch out for these mistakes. Chasing pumps. Don't rush into a trend that's already too extended. Ignoring market reversals. Trends don't last forever. Watch for signs of a trend break. Always trust signs and never include emotions. Let's recap for a second. As you saw, the trend following strategy is neither long-term nor short-term. It depends on a trend. Therefore, you need to invest more time, knowledge, and discipline if you want to be successful in this strategy. It is much more complex than the previous two. But on the other hand, if executed properly, it can gain you much more than the previous two. All right, moving on to strategy number 4, which is day trading. All right, let's break it down. Day trading means buying and selling crypto within a single day, making small but quick profits multiple times, taking advantage of short-term price movements. Unlike long-term investors who hold, day traders don't care about the long-term price. They just want to make money from daily price swings. Real-life example. Think of it like flipping sneakers. You buy limited edition Nikes for $200 in the morning, and by the afternoon, demand has pushed the price up to $250. You sell, take your profit, and repeat. Bitcoin can move 3 to 5% in a day. Altcoins can pump 10 to 20% in hours. Compare that to the stock market, where prices move 1 to 2% per day. Crypto offers way more opportunities to make money every single day. Example, Ethereum starts the day at $3,000. A sudden surge pushes it to $3,300. A day trader buys at $3,050 and sells at $3,250. Quick $200 profit per coin. Before you start, here's what you need. A crypto exchange with low fees. Binance, Bybit, Kraken, or Coinbase Pro. A trading strategy. More on that in a second. A risk management plan. Never risk everything on one trade. Time and focus. Day trading requires watching the charts daily. All right, let's talk strategies. Here are 3 powerful methods used by pro traders. 1. Scalping, the fastest strategy. Scalping is all about making super quick trades, holding crypto for minutes or seconds to grab small profits many times a day. Example, Bitcoin jumps from $42,000 to $42,200 in 5 minutes. A scalper enters at $42,050 and exits at $42,180, making quick profit. In order to do that successfully, you must have knowledge about technical analysis, indicators, and have a disciplined strategy. 2. Breakout trading, catching big moves. This strategy focuses on buying when the price breaks key resistance levels. When an asset moves past a strong barrier, it usually explodes in price. Example, Ethereum is stuck at $2,000 for days. Suddenly, price breaks above $2,050 with high volume. A breakout trader enters at $2,060 and rides the move to $2,200. This would be the closest thing to trend-following strategy, but on a daily level. So profit is faster, but there is always a risk of a false breakout, which can result in losses. 3. RSI and moving average strategy. The classic. If you don't want to rely on gut feeling, indicators can help. How it works. RSI, or Relative Strength Index, shows if crypto is overbought or oversold. Moving averages, or MA, help spot the trend direction. Example trade. Bitcoin's RSI drops below 30, oversold. Price touches the 200-day moving average. A trader buys, expecting a bounce back up. This one is the slowest and, let's say, safest out of all 3 we mentioned. Okay, let's recap day trading for a second. On a first look, it looks super tempting. Everyday profits, dopamine rush, quick money. But the truth is far away from that. In order to be successful doing day trading, you must have an insane amount of knowledge, crazy discipline, super resistant character, and insane emotional stability. Also, you need to be present all the time. And when you add all requirements, you will realize that day trading is basically a job that requires insane skills and dedication. That is why the percentage of successful day traders is estimated between 5 and 10%. So if you're not ready to invest time and effort, you better stay out of this strategy. All right, let's move on to growth investing. All right, let's break it down. Growth investing means finding crypto projects with high growth potential, investing in them early before the masses catch on, holding as they gain adoption, increase in value, and explode in price. Unlike day traders who flip coins fast, growth investors look for long-term potential. It's like betting on the future leaders of crypto. Imagine you bought Amazon stock in 1997 when it was just an online bookstore. If you held on, you'd be sitting on millions today. Growth investing in crypto is similar. You're looking for the next Bitcoin, Ethereum, or Solana. The crypto market is still young, and that's why growth investing is so powerful. Bitcoin and Ethereum weren't always giants. In 2011, Bitcoin was worth $1. In 2015, Ethereum launched at 75 cents. In 2021, Ethereum hit $4,800. Early investors saw insane gains. Most people focus on what's already big, but smart investors look for the next big thing. That's how you win with growth investing. So, how do you find a crypto that's about to take off? Here are 3 key factors to look for. 1. Strong use case and real-world adoption. Ask yourself, does this crypto solve a real problem? Ethereum brought smart contracts to crypto. Polygon made Ethereum transactions faster and cheaper. Chainlink connected blockchains to real-world data. Projects that solve real problems tend to grow fast. 2. Developer and community activity. A strong project needs an active team and engaged community. How to check this? Look at their GitHub. Are developers actively updating it? Check Twitter and Discord. Is there a strong community backing it? And also make sure to follow me on Twitter. Link is in description of the video. Read the white paper. Does it have a long-term vision? Solana had a passionate developer community, which helped it grow from 1 to 250 plus in 2021. 3. Strategic partnerships and adoption. A project backed by big companies or institutions is a huge green flag. Polygon partnered with Disney, Adidas, and Starbucks, which resulted in more adoption. Chainlink provides data feeds to major DeFi platforms, which equals in more demand. The more real-world adoption a crypto has, the more likely it is to grow. Now that you know what to look for, here's how to find these coins before they go mainstream. Check CoinMarketCap and CoinGecko. Look for low market cap gems with strong fundamentals. Follow crypto influencers and analysts, but always do your own research. Join early presales and IDOs. Some projects offer early investments before public listing. Watch for exchange listings. Coins that get listed on Binance, Coinbase, or Kraken often pump. Look for undervalued projects that have strong fundamentals but haven't gone viral yet. Before you dive in, let's talk about the risks. Growth investing can be high reward, but it's also high risk. Not every project succeeds. Some new cryptos fail or turn out to be scams. Market crashes happen. Prices can drop fast, so patience is key. It requires research. You need to study projects, not just buy hype coins. How to protect yourself. Diversify. Don't put all your money in one project. Invest in real utility, not hype. Still not convinced? Here's how growth investing made early investors rich. In 2011, buying $1,000 of Bitcoin would be worth over $60 million today. In 2020, Solana was $1.50. In 2021, it hit 250 plus. That's a 16,000% gain. So, should you try growth investing in crypto? If you want to find the next 10x or 100x projects, are willing to do research and hold long-term, can handle some risk for big rewards, then yes, growth investing is a powerful way to build wealth in crypto. I would recommend it rather than day trading because you can diversify, and even if you lose few, in the end, if you catch that one gem that goes 1000x, everything is worth it. But similar to day trading, it also requires a lot of time and unbiased research with constant updates. And that's about it for basic strategies. Now we are moving to more serious strategy, which is arbitrage, and we will explain it in 5 key topics. All right, let's start topic number 1 with some real-life example you can easily relate to. Imagine you are 18 years old and you wash windows of your neighbors for $20. Neighbors need their windows cleaned every 20 days, and you, as an 18-year-old, have all the time in the world to clean them. It is a win-win situation. Now let's go forward a few years. Now you are 24 and you have a serious job now, so you don't have so much free time anymore, but your neighbors still need their windows cleaned. You then go and ask neighbors if they are willing to pay $30 instead of $20 now. Since you were a trustworthy service provider for them for last 6 years, they accept the new price. Now you know a guy from 1 block away that is 18 years old. You ask him if he is willing to start doing a job of cleaning windows in your street for $20. Now he is making $20 per house, and you are making $10 per house. Neighbors are happy, and you are still making money from it without much work at all. You are just setting up that job and making money with very small amount of risk. Just think about it. What is the worst thing that could happen here? A guy cleaning windows can quit in middle of a job. Then you would need to do one of the two things. Either go and finish the job yourself and keep the profit, or refund your neighbors until you find a second guy to work. So if we break it down, you are buying a service for $20 and selling it for $30. This lets you make profit of $10. So we can say you are benefiting from window cleaning arbitrage service. And yes, that is exactly what arbitrage is, taking advantage of market differences at a given time. The whole point of arbitrage is to do a super quick trade and make profit. In this case, you were buying for 20 and selling for 30 in a matter of few hours. If you got that right and you subscribe to the channel, we can move to topic number 2, which is arbitrage in crypto. As our previous example already said, with cryptocurrencies, it works the same way, with slight differences. But the core principle stays the same. You want to buy crypto somewhere and sell it somewhere else at higher price. But first, difference will be time. You will be able to see in some examples we will show that unlike our Windows cleaning example from topic number 1, this happens in matter of minutes instead of hours. And this one needs to be done strategically. By doing this, you are not buying and hoping that the price goes up by some percent. Price movement hardly even matters. Only important thing is price difference between place you are buying at and place you are selling at. Okay, but how is this even possible? Well, you see, world of cryptocurrencies is still pretty young, and between various crypto exchanges, there are different liquidity variances. And don't stress when you hear a new term like liquidity variance. As I promised, I will break it all down so everyone can understand it. If you don't know anything about crypto, I would suggest going to watch our 24-minute course for complete beginners after you finish watching this one. Link will be down in description. Okay, breaking down liquidity variance for a second. Imagine some currency is stacked in a pool, along with countercurrency. So let's say in one pool, we have Bitcoin and US dollar together. Now, when people want to buy Bitcoin, they need to leave US dollars inside pool in order to take it, and vice versa. So every time someone buys Bitcoin, there is less Bitcoin in pool and more US dollars. By doing this, price of Bitcoin grows because pool wants to keep both Bitcoin and US dollar inside it in order to continue doing business. Because if the price didn't move after putting some amount of US dollars inside it, there would be no Bitcoin left and pool would go out of business. This is called law of price and demand, the oldest and most fair law of finance. Okay, now that this is clear, let's get back to topic. We said there are sometimes liquidity variances between different crypto exchanges. But why? Simply because different exchanges have different pools. Larger exchanges have larger pools, and smaller exchanges have smaller pools. So price can move faster on smaller ones and slower on bigger ones, because it takes less amount of US dollars to move the price in smaller pools. And that is where you come in. You simply spot the difference of a given currency in a given moment and take advantage of that, buying it lower in one exchange and selling it higher in other exchange. This is much less risky strategy than day trading, for example, where you would need to rely on predicting price movement. And if you want to know more about various crypto investing and trading strategies, make sure to check this video. Link will also be down in description. Many traders call arbitrage a risk-free trading strategy because you are first finding trade opportunity and then making a move that will benefit you in a matter of minutes. For example, you find a car that is selling for $10,000, and then you find a guy that is willing to pay $12,000 for it. You simply connect the two. There is little to no risk since you are not even buying the car. Okay, let's move on to some real examples by going through topic number 3, which is types of arbitrage in crypto. Okay, let's dive deep in some examples. First type of crypto arbitrage is known as simple or direct arbitrage. And as the name suggests, it is pretty simple and straightforward strategy. You are essentially buying on one exchange and selling it on another one. For example, I would buy Bitcoin on Binance Exchange at the price of $80,000. Then I would transfer that amount of Bitcoins to my account at Coinbase Exchange. I would then sell it on Coinbase because the current price is $80,010. This would make me a solid $10 profit for just a few minutes of actual work. Now you might be thinking, but I can buy a bunch of Bitcoins and multiply this profit. It is simple math, but this is the part where it gets a little bit tricky. This simple arbitrage method will only work for a short period of time. until my buying moves the price inside prize pool and prices even out. You remember how liquidity pools work? Just understand that I can't do this for, let's say, 1,000 Bitcoins. It can only be done with few before liquidity pools from these two exchanges don't even out, because the same applies for the exchange we are selling to. Price will lower down the more we sell on it. Same way it goes up on exchange we are buying at. Now, in the world of cryptocurrencies, there is also one more thing you need to consider, which are fees. You see, each transaction for cryptocurrency costs money, and depending on many factors, that fee may differ. So since we used Bitcoin as example, you should know that fee for sending Bitcoin can sometimes be even $10 or $20 for a single transaction. Because Bitcoin is #1 cryptocurrency and network is super busy all the time. So same applies for transaction fees as it applies for price movement. The more people try to send transactions at one time, the higher the price for that transaction gets. And if you want to understand how Bitcoin works, check this video on our channel. Apart from transaction fees, there are also exchange fees. Each exchange has its own fees for trading and interacting with crypto on their platform. So you would also need to consider that factor. Okay, but why are we even talking about arbitrage anymore? It sounds impossible. Yes and no. You see, we use Bitcoin as example, but there are infinite amount of cryptocurrencies and exchanges out there with much lower fee costs. For example, Ripple or XRP is a cryptocurrency with super cheap transaction fees. Simple arbitrage works. You just need to find opportunity and factor all things, so it makes mathematical sense. Okay, moving on to second type of arbitrage, which is called triangular arbitrage. It is a bit more complicated than simple arbitrage is, but on the other hand, it works, and people make money with it every day. In order to explain this one, I need to teach you how to start thinking outside of fiat currencies like US dollar. By now, I was using cryptocurrency examples like Bitcoin, and I was comparing its price with US dollar. But now we need to dive in further. Instead of looking at currency price in US dollar value, we will compare it between two cryptocurrencies and US dollar, making a triangle shape. And that is why this is called triangle arbitrage. So for this case, we will use a pair of Ethereum and Solana coins. So basically, you would go on and buy Ethereum for US dollar, then buy Solana with that Ethereum, and then sell Solana for US dollar, therefore closing the triangle. Okay, but how are we actually making money by doing this? You see, as I said, it is a bit more tricky than previous one, especially if you are new to trading crypto. But same way as simple arbitrage, you are making money from price differences somewhere in between. But instead of finding price differences for one asset, you are looking for price difference between 3 assets. So in this particular case, you find opportunity where you can get more Solana coins by buying it with Ethereum, then by buying it direct with US dollar. So there are 2 pairs that have current difference you can benefit from. So let's set this example so you can understand better. On the left side, you see Solana and Ethereum price in US dollar value, which is, let's say, $200 for Solana and $2,000 for Ethereum. And on the right side, you can see Solana price in ETH value, which is 0.095 Ethereum. Let's imagine you go inside this trade with $2,000. You would first buy Ethereum, which would get you a total of 1 Ethereum. Then you would buy Solana with that Ethereum at exchange rate I told earlier of 0.095 Ethereum per Solana, which would give you 10.53 Solana. And lastly, you finish trade by selling your Solana back to US dollar at $200 price, which would give you $2,106. So your profit is $106. And same as simple arbitrage, you need to consider fees for exchanging these assets. And you won't be able to do this infinitely, because every action would change the price until it evens out. Because unlike traditional finance, where governments can print infinite amount of money, creating inflation and manipulating price, serious cryptocurrencies don't allow such features. So same as before, you can make money on a small margin in small amount of time until price evens out. Moving on to topic number 4, which is trading bots. Okay, since we confirmed that arbitrage trading in crypto is a profitable way to make money, it is safe to assume that there will be competition in doing so. And there absolutely is. Serious arbitrage traders are developing bots that fetch data from the internet and alarm traders when certain price difference criteria are met. Since speed is the key factor in doing arbitrage, instead of relying on human eye, focus, and speed, it is much better to have computing power doing this. How do you get these bots? To be honest, the chance of you obtaining one is really low. Developers are being paid millions of dollars every day to create these bots. Competition in this market is way too high for a new person with little to no knowledge and resources to get into. People that are inside this kind of business are millionaires or even billionaires, and the average person can't hope to compete with that. It would be similar to going on a car race with your Toyota Yaris and competing against Lamborghini cars. Your chance is basically non-existent. Apart from bots that fetch data regarding prices, there are also bots that perform trades at lightning speed, which are even more complex than the previous bots. They get the info about the price, and if criteria are met, they perform the exchange themselves without the user needing to do anything. Sounds like a dream, but just know that if you ever reach a point of doing this, you have already reached financial freedom. And the truth is that the more money you have, the easier it gets to make more money. This example proves it. Another problem with trading bots is the insane development of technology. With AI blooming every single day, new and better solutions to technical problems are being invented, making it even harder to stay relevant in this line of trading. It is a rich game, without a doubt. There are websites where you can subscribe to find arbitrage opportunities for you. But once again, saturation is super high, and they can't compete with the development of bots. So I wouldn't recommend trying them. But does this mean doing arbitrage trading is impossible? Absolutely not. People have been doing arbitrage for years. In fact, before crypto was even invented, people were doing it with other assets. The same core principles apply to the stock market, and even with traditional currencies. Every day, people are exchanging US dollars for euros, British pounds, and so on all across the world. Because there are price differences all around the world, and we live in the digital era, where that information is pretty easy to find and execute trades from your bedroom. Getting back to crypto, there are a ton of small crypto exchanges that are not on the radar of these bots, and the only competition there are humans. People just like you. This makes it more user-friendly for beginners and people with limited resources. As we said, smaller exchanges have smaller liquidity pools, making it more realistic to spot price differences. And competition is not that high if you compare it to the top 10 or 20 exchanges. So, if you are looking to do arbitrage trading, this is the way you should approach it. But take note, like any line of business, it takes time and dedication. You need as much knowledge about it before diving in if you want to be successful. Understanding crypto in general, fee costs, operation costs, and so on will give you the advantage over others. That is the only way you can be successful in doing it. Any form of market trading is pretty simple and straightforward. In order for you to make money, you need to stay ahead of others. Okay, moving on to topic number 5, which is the risks of arbitrage trading. On paper, crypto arbitrage sounds great. You sit by your computer, find an opportunity, execute the trade, and take profit. But the truth is that there are many risks involved in this strategy, which make it harder to do. Let's divide them into 3 chapters. Chapter number 1, scams. As we said in the beginning, crypto is still very young. Because of that, many things still lack regulation. This fact gives hackers and scammers more space to operate fraudulently. Gaining knowledge is the only way to protect yourself. Scammers can create fake exchanges that look exactly the same as legit ones, with maybe only a different domain name. If you don't know what to look for, you may deposit your funds and lose them immediately, because in crypto, once a transaction is done, there is no refund. No one can reverse or stop your transactions. Scammers can also target you through email and social media, presenting themselves as authorities from exchanges, for example. They get you to click on a link, and in a matter of minutes, they steal your funds and data. So how to avoid being scammed? You always need to go only through official sources when interacting with crypto. For example, if you want to go to the Binance exchange, one of the safest ways would be to go on Twitter. Find the official Binance account, confirm that it is the real account by looking at the follower count, engagement on the page, and the checkmark. After that, you click on the link on their page, which will take you to their website. This way, you avoid any possibility of being potentially scammed. Chapter number 2, small exchanges. We mentioned earlier that the best arbitrage trading chances for regular people are in small exchanges. And that is true, but there is also a downside to this. You see, small exchanges have small liquidity pools, which lets prices fluctuate more, but it also holds more risks. Price changes can happen drastically in a matter of minutes if developers didn't do a proper job in the back end. You must understand that smaller exchanges have smaller budgets for development and maintenance than top ones. These problems can end in exchange bankruptcy. Glitches can happen, resulting in freezing or losing your funds. So you would need knowledge to distinguish between a small exchange that is reliable and one that isn't. Chapter 3. Volatility. Crypto can be incredibly volatile, meaning prices can change dramatically, sometimes by more than 30% in a matter of seconds. In order to do this, you want to target smaller cryptocurrencies because there is a higher chance to spot price differences. But like smaller liquidity pools, it is the same with smaller currencies. They can change price much faster because less money is needed to move the price. So while performing an arbitrage trade, you might end up in the middle of a trade, looking at a chart with a huge price movement. This would result in you losing not only your profit, but also a portion of your funds. Because price difference won't matter anymore in case your currency lost more value than that difference would have earned you. And we saved best for the last, and that is copy trading, the most compelling trading strategy in world of crypto. So without losing time, let's move to topic number 1, which will explain what exactly copy trading is. Copy trading is like having a mentor who makes all the trading decisions for you while you simply follow along. Imagine walking into a busy restaurant and instead of studying the menu yourself, you notice a food critic at the next table who clearly knows what they're doing. When they order their meal, you tell the waiter you'll have the same. That's essentially how copy trading works in crypto. Except instead of meals, you're mirroring trades from experienced investors who have proven track records. The beauty of this approach is that it removes the steep learning curve that normally comes with crypto trading, making it perfect for beginners who want to participate without becoming experts overnight. The reason copy trading has exploded in popularity comes down to accessibility and time savings. Most people interested in crypto don't have hours each day to analyze charts or keep up with market news, but they still want exposure to potential profits. Platforms like eToro and Binance recognize this need and built systems where you can automatically copy every trade made by seasoned professionals with just a few clicks. What makes this especially appealing is the transparency. You can see exactly how well each trader has performed over time, including their win rates, average returns, and risk levels before deciding who to follow. It's like being able to check a chef's customer satisfaction ratings before ordering their recommended dish. While the concept sounds simple, there's more to successful copy trading than just picking the trader with the highest returns. The crypto market moves fast, and strategies that worked yesterday might not work tomorrow. Some traders take enormous risks to chase big gains, which can lead to equally big losses when the market turns. Others might show impressive short-term results, but lack consistency over longer periods. This is why understanding how copy trading works behind the scenes is crucial before putting your money on the line. The best approach combines the convenience of automated trading with smart decision-making about who to follow and how much to risk. What many beginners don't realize is that copy trading platforms make money whether you win or lose. They typically charge fees through spreads, commissions, or profit-sharing arrangements with the traders you're copying. This creates potential conflicts of interest where platforms might promote certain traders not because they're the best, but because they generate the most fees. The key is to look beyond flashy marketing and dig into the actual performance data. Just because someone calls themselves a pro trader doesn't mean their strategy aligns with your financial goals or risk tolerance. The most successful copiers treat it like hiring a financial advisor. They do their homework first. The psychological aspect of copy trading often gets overlooked too. When you see your copied trader making a losing trade, the instinct might be to stop copying them immediately. But even the best traders have losing streaks, and jumping from one strategy to another during market volatility can lock in losses. This is why many successful copy traders choose a small group of proven traders to follow, allocate their funds wisely, and then give the strategies time to work, rather than reacting to every market swing. The real power of copy trading comes from combining the expertise of others with your own discipline and patience. You see, we barely started and you already know so much, but real juice is yet to come. So sit tight as we move to topic number 2, which will explain how copy trading actually works. Picture walking into a high-tech control room where every decision gets executed with precision. This is what happens behind the scenes when you click copy on a trader's profile. The process is simpler than most people think, yet understanding these mechanics helps you use copy trading tools more effectively. It all starts with selecting a trader to follow, which is like choosing a driver for your investment journey. Platforms display performance statistics that act as a report card for each trader, showing how they've handled different market conditions over time. Once you've picked someone whose strategy aligns with your goals, you decide how much of your funds to allocate. This isn't an all-or-nothing decision. You might choose to test the waters with a small percentage of your portfolio before committing more. The real magic happens in the automatic execution phase. Modern platforms create a digital link between your account and the trader's activity. When they enter a position, your account mirrors that move proportionally based on your allocated amount. If they invest 5% of their portfolio in Bitcoin, your account does the same with 5% of whatever funds you've assigned to copy them. The system handles all the calculations instantly, adjusting for differences in account sizes automatically. What many don't realize is how these platforms manage the practical details. They constantly monitor the trader's activity and instantly replicate it across all copiers' accounts, handling everything from order execution to position sizing. The technology works around the clock, meaning trades can happen even when you're offline. This constant synchronization ensures your portfolio moves in lockstep with the trader you're following, minus any delays that could impact performance. The relationship between trader and copier involves careful balance. While you benefit from their expertise, you maintain control over your risk parameters. Most platforms let you set stop-loss limits or adjust position sizes relative to your account balance. These safeguards help prevent a situation where a trader's risky move could disproportionately affect your portfolio. It's like having an expert driver, but still controlling the speed limit and route preferences for your own vehicle. As the copied trader adjusts their positions for taking profits, cutting losses, or rebalancing their portfolio, your account automatically makes identical adjustments. The system handles all these operations seamlessly, creating a hands-off experience that still reflects the trader's strategic decisions. This ongoing synchronization is what makes copy trading fundamentally different from simply looking at someone's trades and trying to mimic them manually, where delays or emotional hesitation could lead to missed opportunities. Understanding this operational backbone helps explain why copy trading has become such a powerful tool for market participation. The technology removes the traditional barriers of time, expertise, and emotional discipline that often trip up individual investors. Yet, as with any financial tool, its effectiveness depends on choosing the right traders to follow and maintaining appropriate risk controls, which are elements we'll explore more deeply as we continue through our topics today. And just like that, we are moving to topic number 3, which will teach you what types of copy trading exist. But first, let me congratulate you on making it this far. Trust me when I say that you already know more than 90% of people involved in crypto. Now let's make that margin even higher and not waste time anymore. Topic number 2, types of copy trading. Not all copy trading works the same way. Platforms have developed various approaches to match different investor personalities and goals. Understanding these variations helps you find the method that best fits how you want to engage with the markets. The most basic form is full copy trading, where your account automatically replicates every single move your chosen trader makes in exact proportion. This is like putting your investment portfolio on autopilot, with every trade entry, adjustment, and exit mirrored precisely. While this hands-off approach requires the least effort, it also demands the most trust in the trader's strategy, since you're committing to follow all their decisions without filtering. Some platforms offer partial copying options that act more like a suggestion box than a strict mirror. These systems allow you to review each proposed trade and decide individually whether to execute it in your account. This middle ground approach gives you more control while still benefiting from someone else's market analysis. It's particularly useful when following multiple traders simultaneously, as you can pick and choose which signals to follow based on how they fit together in your overall strategy. Social trading networks represent a more interactive version where the line between copying and learning blurs. These platforms combine trade copying with community features that let you discuss strategies with traders, see their market commentary, and understand the reasoning behind their moves. Some even show what percentage of other copiers are following each trade in real time, creating a crowdsourced perspective on market sentiment. This environment often helps beginners gradually develop their own understanding of markets while still benefiting from expert guidance. Automated allocation systems represent the most sophisticated evolution of copy trading technology. These advanced platforms don't just copy trades, they dynamically adjust how much of your portfolio gets allocated to each trader based on ongoing performance. If a trader starts underperforming, the system automatically reduces exposure to their strategy while increasing allocation to better performing alternatives. This creates a self-optimizing portfolio that evolves with market conditions without requiring manual rebalancing. The variety of copy trading methods means there's likely an approach matching any comfort level, from complete beginners who want full automation to more engaged investors who prefer maintaining some control. The key is recognizing that these aren't just technical differences in how trades get executed, but fundamentally distinct ways of participating in markets that suit different personalities, goals, and levels of available time. As the industry continues evolving, we're seeing even more hybrid models emerge that blend these approaches in innovative ways. What all these variations share is the core promise of copy trading: democratizing access to professional-grade strategies while removing traditional barriers to market participation. Whether through complete automation or more interactive approaches, they all aim to bridge the gap between retail investors and institutional-grade trading techniques. The challenge lies in selecting not just which traders to follow, but which method of following them best aligns with your investment temperament and objectives. Once again, congrats! You made it past half of today's video. Looks like you are serious about finding that financial freedom. And if you are, then you are ready to dive in. Topic number 4, pros of copy trading. Imagine having access to a team of professional traders working for you around the clock without needing to pay expensive hedge fund fees. This is the fundamental promise of copy trading. It flips traditional market participation on its head by giving everyday investors institutional-level advantages. The benefits extend far beyond just convenience, touching on some of the most challenging aspects of successful investing. One of the most powerful advantages is the democratization of market knowledge. In traditional finance, the best strategies and insights were typically guarded by Wall Street firms with teams of analysts. Copy trading breaks down these walls by allowing anyone to benefit from proven traders' expertise. It's like suddenly having access to the playbooks of successful hedge funds. Except instead of just reading about their strategies, you can automatically implement them in your own portfolio. This levels the playing field in ways that were unimaginable just a decade ago. The time-saving aspect transforms investing from a second job into a background process. Active trading typically requires constant market monitoring, technical analysis, and emotional discipline, demands that overwhelm most people with jobs, families, and other responsibilities. Copy trading handles all the execution work automatically, freeing you from screen time while still maintaining market exposure. This automation is particularly valuable in crypto markets that operate 24/7 across global time zones, where important moves often happen when most people are sleeping or occupied with daily life. Risk management takes on a new dimension with copy trading's built-in diversification potential. Rather than putting all your capital behind a single strategy, most platforms allow you to spread allocations across multiple traders with different approaches. This creates a natural hedge. When one trader's strategy underperforms in certain market conditions, others in your portfolio might excel. Some platforms even provide correlation metrics showing how different traders perform relative to each other, helping you construct a balanced copy portfolio, just like institutional investors build diversified fund allocations. Perhaps the most underappreciated benefit is the educational value that comes from observing professional traders in action over time. Unlike simply reading trading tips or watching tutorial videos, copy trading lets you see real-world decision-making unfold in your own portfolio. You witness how experienced traders handle volatility, adjust positions, and manage risk through complete market cycles. This live apprenticeship model helps many users gradually develop their own market understanding while still generating potential returns during the learning process. The psychological benefits shouldn't be overlooked either. Many individual traders struggle with emotional decision-making, buying when prices spike due to FOMO, or panic selling during corrections. Copy trading creates healthy distance from these impulses by automating execution based on predetermined strategies rather than emotional reactions. Your portfolio follows a disciplined approach even when market turbulence might tempt you to abandon your plan. This behavioral guardrail prevents many common mistakes that typically erode retail investor returns. What makes these advantages particularly compelling is how they compound over time. The time savings, professional strategies, and emotional discipline work together to create an investment approach that's greater than the sum of its parts. While copy trading isn't without its challenges, as we'll explore in our next topic, its core benefits address some of the most persistent obstacles facing individual investors. These advantages explain why what began as a niche platform feature has grown into one of the most transformative developments in modern investing. But like everything in world, nothing is perfect. Same applies for copy trading. And that brings us to topic number 5, which is cons of copy trading. While copy trading opens exciting opportunities, it's not a magic money machine. Understanding its pitfalls separates savvy investors from disappointed followers. The risks often hide in plain sight, disguised by impressive performance stats and slick platform marketing. The most dangerous trap is blindly trusting trader profiles without digging deeper. Those shiny 300% return figures might only show a short hot streak, not long-term consistency. Some traders take wild gambles to juice their numbers temporarily, knowing new copiers will chase the big percentages. It's like seeing a basketball player's highlight reel without watching full games. You miss the turnovers and bad shots between the spectacular dunks. Many platforms display returns without proper context about risk taken to achieve them, making moderate but steady performers appear less attractive than they really are. Lack of control becomes a double-edged sword. While automation saves time, it also means you're along for the ride on every trade, good or bad. Unlike traditional investing, where you can skip questionable moves, copy trading executes all signals automatically. Imagine being stuck in a car where someone else controls both the accelerator and brakes. You might love the speed on straightaways, but panic during reckless turns. This becomes especially problematic during market crashes, when even experienced traders make emotional decisions that get mirrored in your account instantly. Fee structures quietly eat into returns in ways many beginners overlook. Beyond obvious charges like profit sharing, where traders take 10 to 30% of your gains, hidden costs lurk in wider spreads, withdrawal fees, and currency conversion charges. Some platforms prioritize promoting traders who generate the most fees, rather than those with the best risk-adjusted returns. It's like going to a restaurant where the waitstaff gets bigger commissions on certain dishes. You might not get the most objective recommendations. These financial conflicts of interest rarely appear in bold warnings. The technology itself creates unique vulnerabilities. Platform outages during volatile periods can prevent trade adjustments, while the traders you're copying continue managing their positions elsewhere. Some copy systems have slight execution delays that cause you to enter positions at worse prices than the original trader. There's also the risk of traders gaming the system, placing small personal trades while showing copiers different positions to manipulate their visible performance stats. These technical gremlins rarely surface until markets turn chaotic. Perhaps the most overlooked risk is strategy mismatch, following traders whose approach doesn't align with your actual risk tolerance. A trader might specialize in wild 100x leverage bets that pay off until they don't, while their copiers assumed they used conservative 5x positions. Without understanding a trader's true methodology, you could accidentally take on far more risk than intended. It's like ordering what looks like iced tea, but getting served a stiff cocktail instead. By the time you realize the difference, it might be too late to adjust. These risks don't mean copy trading should be avoided, but they do mean it should be approached with the same due diligence as any serious investment. The most successful copiers treat it like hiring a financial advisor. They verify track records, understand fee structures, and maintain appropriate safeguards. And that exactly brings us to the final and maybe most important topic of today's video: how to find a good trader to copy from. But before we dive in, if you wish to learn about the top 4 cryptocurrencies, even if you don't know anything, make sure to watch our ultimate course explaining them. The link will be down in the description of this video. Now, getting back to topic number 6. Finding truly skilled traders to follow isn't about chasing the highest returns. It's about uncovering consistent performers who match your investment personality. The process resembles hiring for an important job position rather than picking lottery numbers, requiring careful evaluation beyond surface-level statistics. Start by examining performance across different market conditions, not just overall returns. A trader who thrived in last year's bull market might collapse when trends reverse. Look for those who maintain stability during both rallies and crashes, as their strategy likely has depth rather than just riding temporary waves. The best performers often show smaller but steadier gains month after month, not astronomical returns followed by devastating drawdowns. Risk management tells more about a trader than their winning trades ever could. Dig into their maximum drawdown, the worst peak-to-valley decline in their history. If they've regularly lost 40 to 50% of their portfolio before recovering, their strategy might be too volatile for most copiers. Similarly, check their average risk-reward ratio. Traders risking 1 to make 0.5 might win often, but will eventually get crushed by a few big losses. Those with disciplined risk-to-reward ratios of 1 to 2 or better demonstrate smarter position planning. Activity level matters more than most beginners realize. Hyperactive traders making dozens of trades daily often rack up fees and emotional decisions. On the flip side, someone placing only a couple of trades monthly might not provide enough data to evaluate their edge. Look for balanced approaches, typically 5 to 15 quality trades per week, showing thoughtful selection rather than gambling impulses. The trader's own skin in the game speaks volumes. Many platforms now show how much of the trader's personal funds remain invested in their strategy. Those eating their own cooking, keeping significant capital in their own trades, tend to make more careful decisions than those playing with house money from copiers. It's the difference between a chef who tastes every dish before serving versus one who never eats the restaurant's food. Transparency separates serious traders from marketing hype. The best willingly share their methodology, typical holding periods, and what market conditions their strategy suits best. Beware of vague descriptions like proprietary algorithm without explanation. Real professionals can describe their edge in simple terms. Also, check comment sections where copiers discuss their experiences. Patterns of complaints about unexpected moves often reveal problematic behaviors. Diversification applies to choosing traders too. Instead of going all in on one star performer, build a team of 3 to 5 traders with complementary styles. Maybe pair a cautious Bitcoin spot trader with an aggressive altcoin specialist and a defensive hedging expert. This creates natural balance. When one strategy struggles, others may thrive. Most platforms let you allocate different percentages to each, letting you customize your exposure like a mini hedge fund manager. The final test comes from paper trading or small allocations first. Even the most promising statistics deserve real-world testing with minimal risk before committing serious capital. Watch how the trader handles live markets with your money on the line. Their response to losses often reveals more than their handling of wins. After a few weeks of observed performance, you'll gain the confidence to increase allocations or the wisdom to walk away before larger losses occur. This selection process requires more work than just sorting by highest returns, but it pays off in long-term stability. The best copied traders become valuable partners in your investment journey, not just temporary hot hands. They're the difference between blindly following someone else's map and having an experienced guide who helps you eventually navigate markets on your own terms. Let me truly congratulate you for making it until the end. As you were able to see yourself, knowledge is the essential key part of making success in the world of crypto. And by staying until the end, I can see you are keen to learn. So make sure to watch one of these 2 videos you see on the screen right now. I hope you found this video helpful. If yes, don't forget to subscribe, like, and comment your thoughts. As always, see you in some of our next videos.